In Seattle, between 2019 and 2024, the amount Uber keeps from a single ride jumped from $4.69 to $13.06. That's a 178% increase in 5 years. Over the same period, driver pay went up less than half as much. Now here's what makes this the most important business story nobody is telling you. For 14 years, Uber lost money, a lot of money. $32 billion of accumulated losses before they ever posted a single operating profit. And then suddenly, in 2023, they became profitable. By 2024, they had nearly $10 billion in net income. Most people think Uber finally figured out the tech, the algorithms, the matching engine. Those people are wrong. Here's the story you've been told. Uber is a tech company. A brilliant team in San Francisco used software, data, and machine learning to make transportation cheaper, faster, and more efficient than taxis. They disrupted the sleepy industry, and after a decade of investment, the technology finally scaled, unit economics improved, and Uber became one of the great American business success stories. It's a nice story, but it has a problem. None of the important math in it is true. The actual story is that for 14 years, Uber didn't compete on technology. Uber competed on one thing: who could lose money the longest. Between 2014 and 2022, Uber burned cash at a rate that has almost no historical parallel. At one point, the company was losing over $5 billion a year. If you're thinking like Amazon in the early days, I need you to look at this next chart. Amazon, famously loss-making for years, never came close to Uber's burn rate. Uber was so extreme that Bloomberg, covering the company in 2018, called it a corporate anomaly. They said no company in history had grown so fast or lost so much money so quickly. So when Uber finally became profitable in 2023, the obvious question should have been, what changed? Because the technology didn't suddenly improve. The algorithm wasn't rewritten, so what actually happened? The answer is the business was never what we thought it was. And once you see the real model, you can't unsee it. Let's start with how much Uber actually lost. According to Uber's own SEC filings and analysis by investment research firm Hind Group, Uber had received about $41 billion in paid-in equity capital, while accumulating $33 billion in losses by 2023. In plain English, investors gave Uber $41 billion and Uber set 33 of it on fire. So the question is, who was lighting the match? The two biggest contributors were SoftBank, which poured $9.3 billion into Uber, and Saudi Arabia's Public Investment Fund, which put in $3.5 billion directly for roughly a 5% stake in 2016. Saudi Arabia, the country, is one of Uber's largest shareholders. When you take an Uber, you are participating in a business model that is partially financed by Saudi oil revenue. And here's where it gets interesting. This wasn't random venture capital chasing returns. This was a strategic weapon. Here are 3 facts that, taken together, change how you see this company. In August 2016, Uber surrendered China to Didi Chuxin. Uber had been losing a reported $1 billion a year in China, trying to outspend Didi on subsidies. They lost. In July 2017, Uber surrendered Russia to Yandex in a joint venture merger, another price war Uber couldn't win. In March 2018, Uber surrendered Southeast Asia to Grab, exited 8 countries. Uber's CEO, Daura Khosrowshahi, said at the time, quote, "One of the potential dangers of our global strategy is that we take on too many battles across too many fronts." Translation: Uber lost the price wars in every market where it faced a well-funded local competitor. And that's not even the worst part. Here's what happened to the markets where Uber didn't lose. By 2024, according to Bloomberg's second measured data, Uber controls 76% of the US rideshare market. Lyft has 24%. Between them, they are effectively 100%. That's not a market, that's duopoly. And then something very predictable happened. Between 2018 and 2021, according to data from Rakuten and reported by CNBC, average Uber prices rose 92%. Inflation over that period was about 12%. Uber's prices went up roughly 4 times faster than the cost of everything else. In Chicago, which unlike New York doesn't have minimum pay protection for drivers, average rideshare fares rose 54% between 2019 and 2023. Power switch action, using New York City TNC data, found that fare increases in both cities outpaced inflation by 2 to 4 times. Remember when an Uber was cheaper than a taxi? That was the sales pitch. That is no longer true. In many US cities, Uber is now more expensive than a traditional taxi. Now here's the single most damaging number in this entire story. In Seattle, between 2019 and 2024, the amount of money Uber keeps from each ride went from $4.69 to $13.06. And that's the finding of Drivers Union Washington, analyzing 1.4 million actual trips from driver tax data. That is 178% increase in Uber's cut per trip in 5 years. Over the same period, driver wages went up less than half as much. So where is all that money going? To the drivers? Not really. According to the OB Global Rideshare Report in 2024, in New York City, the share of each fare that actually reaches the driver fell from 72.6% in 2019 to 62.1% in 2023. In the UK, a 2025 study by Oxford University analyzing 1.5 million trips found that Uber's commission went from a fixed 25% up to 50% or more per ride under what they call dynamic pay. UK drivers' gross hourly earnings fell from £22.2 to £19.06. So we have higher prices, bigger take rates, and lower driver earnings. That's 3 pieces of the puzzle. Now watch what they add up to. Here's the thesis. Ready? Uber didn't invent a better business. Uber invented a better way to stay in business while losing money until competitors couldn't match the burn. That was the entire strategy. It was never about technology. The product they were actually selling wasn't rides. The product was a credible threat. A credible threat that they would lose money longer than wood. With $9 billion from SoftBank, $3.5 billion from Saudi Arabia, and tens of billions more from other investors, Uber had the longest runway in transportation history. Didi had enough cash to outlast them in China. Yandex had enough in Russia. Grab had enough in Southeast Asia. But everyone else in the US and Europe, they ran out. And the moment they ran out, Uber stopped subsidizing. They raised prices 92% in 3 years. They tripled their take rate per trip. They squeezed drivers, and all of that flowed to the bottom line. That's how a company that lost $32 billion became a company that earned $10 billion. Not because the technology improved, because the competition disappeared. And now, in 2025, we're watching Uber transition to the final stage of the monopoly playbook. They're building an advertising business, journey ads, sponsored restaurants on Uber Eats. As of the first quarter of 2025, Uber Ads hits a $1.5 billion run rate, growing 60% year over year. Advertising is the purest monopoly rent in business. You only sell ads on platforms users can't leave. Facebook does it, Google does it, Amazon does it. And now, because Uber made sure nobody else has the drivers and nobody else has the riders, Uber can do it too. This is the real business model, finally visible, and it was never ever about a better algorithm. So here's the bottom line. Uber is now profitable, but the mechanism of that profitability is not innovation, it's concentration. They outspend rivals into extinction, inherited the market, raised prices, and squeezed suppliers. That is the oldest business model on earth. It is not a tech story. Which raises 3 uncomfortable questions for the future. First, if Uber's profits depend on being the only option, what happens when autonomous vehicles arrive and reset the competitive landscape? Waymo doesn't need to lose money for 10 years to build a fleet. Second, what happens if driver classification laws change? In California, the UK, and the EU, there is active pressure to reclassify drivers as employees. Uber's entire margin structure assumes drivers are not employees. If that assumption breaks, the math breaks with it. Third, and the one I want you to think about, is this kind of business actually innovation, or is it just capital-intensive, rent-seeking, dressed up in the language of technology? Is it good for an economy when the winners are the people with the most patient money, not the best product? Drop your answer in the comments. I read them all. If you want more videos where the numbers tell a different story than the headlines, subscribe. New videos every Monday and Thursday.